You're drowning in charts, listening to gurus whose picks go nowhere, reading reports until your eyes blur, doing everything right, but your portfolio's telling you you're wrong. That was me. Tons of information, zero wisdom. So I threw it all out, went back to basics with one of the smartest frameworks I've ever seen, from investing legend Mohnish Pabrai. And here's what happened when I used it to hunt for stocks the market forgot existed. Let's start with Mohnish Pabrai. He's an Indian-American investor who's built a hell of a track record. According to published reports, since starting Pabrai Funds in 1999, his fund delivered over 28% annualized returns net to investors through the mid-2000s. That's the kind of performance that gets attention. But here's what makes Pabrai different. He doesn't pretend he invented something new. He openly channels Warren Buffett and Charlie Munger, and he's honest about it. His genius is taking their complex ideas and boiling them down into one powerful word: Dhando. Dhando is a Gujarati term, literally means endeavors that create wealth. But Pabrai's definition cuts deeper. It's about finding low-risk, high-return opportunities. The whole thing hangs on one mantra: heads I win, tails I don't lose much. You're not chasing moonshots. You're hunting for asymmetric bets where the potential upside is massive and the downside is minimal. Here's the story that made it click for me. In the 1970s, Indian immigrants from Gujarat, specifically the Patel community, began arriving in America. Many came with almost nothing. They bought cheap, rundown motels that nobody else wanted. They'd move the whole family into a couple of rooms, live there, run everything themselves, no outside employees. Costs scraped to the bone. That meant they could charge lower rates than competitors and stay busy. They'd take profits, buy another property for a relative to run, and repeat, over and over. Fast forward to today. According to the Asian American Hotel Owners Association, Indian Americans own over 60% of all motels in the United States, roughly 20,000 properties, and about 70% of those owners are Gujaratis with the surname Patel. Think about that for a second. They weren't taking wild risks. They bought simple, cash-flowing businesses cheaply. They had a clear operational advantage. The downside was protected. They were buying real assets at bargain prices. The uncertainty was high. Nobody knew exactly how it would play out, but the bet itself was heads I win, tails I don't lose much. That was my light bulb moment. I'd been chasing high returns by taking high risks. I should have been looking for deals where the risk was practically zero. So I built my own process. 3 simple rules pulled straight from the Dhando playbook. First, invest in simple businesses. Echoing Buffett, Pabrai says only invest in what you can explain in 1 or 2 sentences. If you can't tell me what the company does and how it makes money quickly and clearly, it's out. This means you skip industries with rapid tech changes or weird financial engineering. You want painfully simple businesses. Stuff people need no matter what. Boring products. Essential services. This rule alone eliminates about 99% of stocks, which honestly makes everything way less overwhelming. As Pabrai says in his book, if you have to ask whether a business is in your circle of competence, it's not. Second, invest in distressed businesses in distressed industries. Pabrai loves pointing out that the stock market is a mood ring. Fear and greed create huge gaps between a stock's price and its actual value. When a whole industry gets hit with bad news, investors panic. They sell everything. Great companies get dumped along with the garbage. It's like a fire alarm in a crowded theater. Everyone's stampeding for the exits. You can calmly walk in and pick up bargains, but only if you've done your homework and know there's no actual fire. You're hunting for temporary problems that create the perception of high risk, when really it's just high uncertainty. Third, always invest with a margin of safety. This comes from Benjamin Graham, the father of value investing. It means buying a business for way less than it's worth, buying $1 for 50 cents. This discount does 2 things. It protects you if you're wrong, and it supercharges your returns if you're right. Pabrai argues the margin of safety isn't just about assets on a balance sheet anymore. It's about how durable the business is. It's about the brand itself and its competitive moat. It's about the leadership as well. Sometimes the best safety is finding a great business at a fair price. With these 3 rules, my mission was clear. Find simple businesses in unloved industries, trading at prices that gave me a massive margin of safety. All right, how did I actually do it? I started with a basic stock screener, the free kind on any finance website. But instead of filtering for hype and growth, I did the opposite. I screened for boring. Dead simple criteria. 1. Low price to earnings ratio. Companies that are cheap compared to their profits. 2. Low price to book ratio. Businesses trading below their net assets. Classic sign something's on sale. 3. Simple industry. I scrolled manually through and only kept industries I understood. Manufacturing, basic retail, simple services, tech, biotech, complex finance, all out. 4. Manageable debt. I wanted to avoid companies that could get wiped out in a recession. I was only looking for companies with a reasonable debt-to-equity ratio. After hitting run, I had this list of forgotten, unloved companies. That's where the real work started. I put on my Dondo glasses and dug in. Let me show you what I found. Quick note, this is educational content only. These aren't recommendations. Do your own research and consult a qualified financial advisor before making investment decisions. One company that popped up was a regional furniture retailer. Furniture is simple. People need couches and beds. Easy to understand. The company had been around for over 50 years. Not some fly-by-night operation, but the stock was getting crushed. Why? The market was terrified of a recession. People were cutting back on spending. Classic distressed industry. Total fear. So I looked at the numbers. PE ratio in the single digits. Trading at a PB below 1. Meaning you could buy it for less than its assets were worth. On top of that, a steady cash flow and a history of paying dividends. This looked textbook. Heads, I win. Tails, I don't lose much. The downside seemed protected by physical assets and dirt-cheap valuation. The upside? If recession fears were overblown, or if the company just survived, the stock could easily snap back to normal valuation. Another one was a manufacturer of basic industrial parts. Nuts, bolts, fasteners. Most boring business imaginable. Nobody's tweeting about the next big thing in fastener tech. But the whole manufacturing sector was getting squeezed. Supply chain worries, rising costs. So the stock was in the bargain bin. Numbers were compelling. Low PE, strong balance sheet with very little debt, long track record of profitability. Even had a small moat built on decades-long relationships with industrial clients. The market was pricing it for disaster. But a closer look showed a tough, resilient business facing temporary headwinds. It fit perfectly. Simple company, distressed sector, huge margin of safety. These aren't sexy stocks. You'll never hear about them on TV. They're hidden in plain sight, completely ignored by a market chasing the next hot thing. And that's exactly what I was looking for. Here's what this whole rabbit hole taught me. Successful investing isn't about being complex. It's about clarity, patience, and discipline. It's about completely flipping your idea of risk. The biggest change for me wasn't the stocks I found. It was my mindset. I stopped chasing hype, started hunting for value, stopped trying to predict the future, started focusing on what a business is worth right now. Maybe most importantly, I learned that sometimes the smartest move is to do nothing. To wait patiently for that rare, mispriced bet where the odds are ridiculously in your favor. The Dondo method isn't a get-rich-quick method. It's get rich for sure. Built on minimizing risk while maximizing upside over the long haul. It forces you to be a business analyst first, stock market player second. The whole point is finding those few big, rare bets that can truly move the needle on your wealth. This approach isn't for everyone. It takes patience in a world that demands instant results. But if you're sick of the noise, maybe it's time to give Dondo simplicity a shot. Now, I want to hear from you. What's the most overlooked principle in investing today? Drop your thoughts in the comments. Thanks for watching, and I'll see you in the next one.